Hey, what's up, stock compounders? Brad here. So today I want to talk about how to calculate the intrinsic value of Apple stock as of today, August 10th, 2020. Okay, so let's jump into this. We're going to do a discounted cash flow valuation of Apple. So what do we need to know? We need to know the growth rate, right? The growth rate of earnings for Apple over the next 10 years. We're going to do a discounted cash flow valuation over the next 10 years. So, my estimated growth rate for Apple is 3% per year. And the reason for that is Apple is a mature company, okay? So 3% seems like a reasonable growth value to assign to a mature company like Apple. So growth rate years 1 through 5, 3%, 6 through 10, 3%. If we're dealing with a growth company, a high growth company, we're usually going to have a higher value growth for years 1 through 5 and then kind of taper it down to a more mature company, years 6 through 10. But since we're dealing with a mature company, we're just going to do 3% across the board. Discount rate. So this takes into account the time value of money. So if you're going to give me $100 a year from now, that's not worth as much to me as $100 today. I need to discount that. So the reason I'm using a 10% discount rate, this is really about opportunity cost for me. Because if I wanted to, I could just invest in the market, in the stock market as a whole, like the S&P 500 with an index fund, and get about 10% annually over the long term, okay? So I need to make at least 10% picking individual stocks for that to be worth it for me. So I'm going to discount these cash flows back to present value using a 10% discount rate. Terminal value. So for this exercise, we're assuming after year 10, we're going to sell the business for a multiple of the free cash flows in year 10, okay? And we're going to use a 15 times multiple. Monish Pabrai suggests 15 for a great business, and it would be closer to 10 multiple for a mediocre business. And clearly Apple is a great business. So we're going to use a multiple of 15 to calculate the terminal value based on these year 10 free cash flows. So the information we need to know what free cash flow we're starting with. We need to know how much cash the company has, cash, cash equivalents, and marketable securities. We need to know how much debt the company has. And then we can get our value of equity. We need to know the number of shares outstanding so we can convert that value of equity into the value per share, all right? So let's figure out how to get these numbers. The first one we want is this year 1 free cash flow. So we're going to come over to Morningstar and we're going to look at this free cash flow. So this is the annual free cash flow that Apple has generated. Now you see here, trailing 12 months, it's quite a bit higher than any of these annual figures from 2017, 18, and 19. Now, I'm going to tweak those numbers slightly because you can see here the trailing 12 months of operating income is less than the operating income was in 2018, and yet the free cash flow is quite a bit higher than it was in 2018. So to me, the free cash flow numbers here, they're not giving us a really accurate representation of what the operating aspect of Apple is generating. So I want to kind of give a better representation of free cash flow from the operating business of Apple. So what I'm going to do is I'm going to use a free cash flow somewhere in between 2018 and 2019 figures, because we have an operating income that's somewhere in between the 2018 and 2019 figures. So, I'm just going to go with 61 billion in free cash flow for the latest 12 months. This isn't an exact science, but I think that's a fair representation of what the operating business of Apple is doing. So we've got 61 billion there in year one free cash flow. Now we need to get the cash and marketable securities for Apple. So how we're going to do that, we're going to go to Apple, the investor relations website for Apple. We're going to go to this latest 10Q. That's the quarterly earnings report, the most recent one. We're going to pull up the 10Q, and if you scroll down to page 9, it's going to kind of break down the cash equivalents, and marketable securities for Apple. And what we want is the most recent fair value of these cash and marketable securities. And that's going to give us this number here, $193.6 billion. So we'll plug that in. This is 193.6. It rounds to 194. And now we want the debt. So to get the debt, we're going to scroll down to page 17. Now we're going to look at this debt section. So commercial paper. We've got 6 billion of commercial paper outstanding with maturities generally less than 9 months. So this is kind of the short-term debt. So remember that 6 billion figure. Now we're going to look at the term debt. And we have 100.1 billion for the term debt. So we're going to add those together. So we have 106.1 billion, okay, for short-term and long-term debt. And we need one more piece here, and that is we need these restricted stock units, which are the benefit plans for Apple. This is the minority interest. And we're going to use this aggregate fair value to come up with the minority interests for Apple. So if you remember before, we had 106.1 billion. We're going to add 27.984 billion in minority interests. We're going to come up with about 134 billion in debt and minority interests. Okay, so now we've got everything we need to do some calculation. Oh, we need one more thing. We need the number of shares outstanding. So to do that, we find the market cap of Apple, the market capitalization. We divide that by the share price, which the current share price is about $450 per share. And we get the number of shares outstanding at 4.26 billion, okay, shares outstanding. So now you see in year one we have free cash flow. There's our 61 billion. We need to discount that back to today's value. We're going to do that at this 10% discount rate. So basically how we do that, we're going to take 61 divided by 1.1, okay? That's 1 plus the discount rate of 10%. And we get a present value from the year one cash flow of 55 billion. And we're going to do that all the way through year 10. And then we're going to take the year 10 free cash flow, multiply it by this 15 multiple to get the terminal value, okay? And then we're going to discount that terminal value back 10 years at a 10% discount rate. And essentially how you do that is you take this 1194, you divide it by 1.1 to the 10th power. And that's going to give you 460 billion in present value, okay, from the terminal value. Now you're going to add up all of these present values of free cash flows plus the terminal value discounted back to present value, and you're going to get the present value of future cash flows, okay? And that's $880 billion. You're going to add the cash that's currently on the balance sheet. You're going to subtract the debt to get the value of equity, all right? You're going to divide that value of equity by the shares outstanding. and you're going to come up with a value per share. This is the discounted cash flow valuation that we just did, to get a value per share of Apple of $221 per share. So that's what Apple is worth to me, based on, you know, my projected future cash flows for Apple, based on my assumed growth rate, my assumed, you know, kind of the discount rate that I need to be happy with this investment, and, you know, the multiple of free cash flows that I'm using. So 221. Now the current price of Apple, of course, is $450 per share. So what that tells me is that Apple is currently, Apple is very expensive, okay? The price is more than 2 times as high as the value that I came up with. So, you know, we're working with a deeply negative margin of safety here. And some of you might think, well, you know, you must just be wrong in your valuation, because how can the price be so much higher than the value? Well, you know, there's a few ways I'll answer that. One is the price for shares of Apple less than 5 months ago were about that value, about that $221. They're actually $224 per share near the end of March. If you look back just a year, Apple shares were trading at $200 per share, okay? Now, I would argue in a mature company like Apple, the value of a company isn't going to change that fast, okay? It might change 25% or 30%. So you go from $200 per share to maybe $250 per share. That would be reasonable to me. But to have the largest company in the world doubling, more than doubling in a year is crazy to me, guys. It just doesn't make sense. So I'm perfectly happy with this valuation of Apple, even though it seems like I must have made a mistake somewhere. And I also want to point out these growth rates, 3%, if you go to Yahoo Finance and look at what analysts who are following Apple are suggesting will be the future growth rates of the company. First, let's look at the past 5 years. Okay, you've got a growth rate of 8.4% for Apple over the last 5 years. Okay, 8.4% per year. Now, if you're looking forward from here, analysts think that each year over the next 5 years, Apple is going to grow 12.5%. Okay, this is a mature company, mind you. This is the largest company in the world, the largest public company in the world. Analysts are saying this company is going to grow at 12.5% per year. That's just insane to me. But why don't we do this? Let's do a little exercise. Let's say we take the past 5 years and we assume Apple's going to grow at that rate for the next 5 years, 8.4%. Let's see what that does to our valuation. So let's put 8.4 in here, and we'll assume, you know, it's going to taper down from that 8.4 down to 3% over the following 5 years. So we'll take the average of 8.4 and 3. What is that? About 6. Let's just say it's 6. Okay. So if we do that, our value per share goes from 221 to 285. That's quite a jump. So let's massage this a little bit more. Okay. Because you got to understand, guys, these analysts, they are motivated not by coming up with the most accurate intrinsic value for a company, but they have other motivations here. All right. I'll leave it up to you to evaluate what those motivations might be. But let's see how we can get a little bit closer to the current price with our discounted cash flow valuation. So let's say the discount rate, let's bump that down to 7%. Okay, now we're up to $353 per share. That's getting us a little bit closer. Let's say maybe 15 multiple is a little small. I think maybe we can be a little bit more aggressive with our multiple of free cash flow. Let's use something like 20. Okay, we're getting a little closer. 20 might be a little too conservative still. What if we say 22? All right, guys, you see here, all we did is moved a few numbers. We didn't move them in an insane way. It's not crazy what we've done here. But you see, with just a little massaging of the numbers, we can tweak the valuation by a lot, okay? We went from a price that was double the value, more than double the value, to a price that's really in line with value right now. Just by moving the growth rates a little bit, you could probably justify these growth rates. These aren't growth rates that are crazy. They're not growth rates that are, unachievable. It's possible to hit these growth rates. Reasonable discount rate. And this terminal value, you could potentially justify that. So basically the point I'm making here, guys, is it's really important when you're doing valuations to do the valuation before looking at the price even. That's ideal, because if you know what the price is, there can be this subconscious bias towards selecting these numbers, these inputs that get you closer to kind of the current price, okay? So it's really important to do valuation where you're using the numbers that are most rational to you, and you're not being swayed by trying to make your valuation line up with the current price, okay? So, I have no interest in doing an 8 and 6% growth rate here. I'm sticking with 3. Apple is a mature company. Discount rate, I'm insisting on 10%, because I think that's what I can get without thinking, just by investing in an index fund. And then 15, I don't have any interest in paying more than a 15 multiple in this discounted cash flow valuation for Apple after 10 years. So I'm pretty comfortable with this valuation. And obviously, I'm not going to be buying Apple. Apple has to come down a lot before I'm interested in Apple. Basically, I like to buy companies that are at 2/3 of value. So in order to be interested in this, let's do a quick math here. 221 times 2/3. Apple has to come down to about $150 per share before I'm interested in buying. Of course, we're going to have the stock split later this month. So, considering that, well, it's the same deal. It's got to come down dramatically before I'm interested. It basically has to drop 2/3 from where it is now in order for me to be interested. So, that's fine. I don't need to buy Apple. I can just keep an eye on it and wait until it hits my buy price. And then if it does, I'm happy to buy in. But I just wanted to do this discounted cash flow valuation for you guys on Apple. Apple is so hot right now. Everybody seems to want to get their hands on Apple. And, when investors are clamoring for something, regardless of price, that's a very dangerous game to play. So this is my valuation for Apple. I am happy to wait and not do anything with Apple until it comes down dramatically. Curious how you value Apple at this time in the market. Let me know what value you've come up with. If you have any questions about this valuation, ask in the comments. I will also post a link to this spreadsheet in the description so you guys can, tweak these numbers based on your assumptions and come up with your own value for Apple. All right, guys, that's all I got. I will see you in the next video. Take care.